thank you to my panel. We don't have very long. We've got 25 minutes to talk about what is a pretty meaty topic. So I'm going to ask you all to quickly introduce yourselves, if you don't mind, and then we will get started. Would you like to start?
Thanks, everyone. Happy to be here. My name is Stephen Prosperi. I'm at DTCC, the Depository Trust and Clearing Corporation, which is the CSD and CCP in the U.S. securities markets.
I'm Jacek Wieclawski, so thank you for having me here. So I'm looking and heading up globally our origination, distribution, and trading of digital assets at Rabobank.
Hi, I'm Rahul Banerjee. Nadine couldn't make it, so I got pulled in instead. I'm the CEO and co-founder of Bond Blocks, Bond Exchange, also from Singapore.
Hi everyone, Myles Milston, CEO and co-founder of Globacap. We're digitizing and automating private capital markets. We've deployed white labels that have automated private placements, register management, and secondary liquidity across various global institutions.
Everyone, Mike Demissie from BNY Mellon. I head up our digital asset unit. We see digital asset as the future, from crypto assets to digital cash to tokenized assets, and it's an area that we're investing in across all our businesses.
Thank you very much, and thank you to Rahul for stepping in. Unfortunately, Nadine has COVID, so hasn't been able to join us. So, I'm going to start. What are the advantages of assets becoming digital, and what are you seeing in your own company or the wider industry? Who wants to take that first?
Happily jump in. So the advantages of going digital, I think, are pretty obvious to everybody, starting at, who uses a paper map anymore to get around instead of Google Maps. Actually, it was only 10 years ago that people were still using paper maps to walk around and navigate. 10 years, that's it. And the world has changed very significantly. And yet, when it comes to engaging in a private markets transaction, or in fact, any securities transaction, such as an issuance where you get sent a prospectus or a placement memorandum, and you have to send back an email. There's all of this paper trail that goes on in email. You have to print stuff out, you scan it, you sign it. There's a book building process, which is spreadsheets going backwards and forwards between dealers. It is a minefield of things going wrong, and it is an extremely expensive administrative process for all of those parties involved. So digitizing that is just, it's just common sense.
Yeah, I mean, I guess I'll just add in, we always talk about what are all the things you can do by digitizing securities, and I think a lot of it is all the things you don't have to do if you digitize securities, from reconciliations between disparate systems and paperwork and Excel spreadsheets, and I think the list goes on and on and on, but I think it's just as important, all the things you get rid of rather than add to the stack.
That's right. I mean, you have to look at in terms of what problems it's going to solve for the clients, right? I think in a simple way, you look at, expediting settlement, for example, right? Increasing liquidity and liquid markets, exposing it to different investors. So the technology, there's a very powerful technology that is actually allowing you to transfer value in a different way than we've been able to do it before. So it really unlocks new possibilities. And actually, I would argue these are just incremental cases right now. So if you would compare to the early days of the internet, right? A lot of the initial use cases were just taking what we do today, at that time, and putting it online. I think if you fast forward a couple of decades and look at actually completely new business models, I don't think we're starting to see that yet. And so this is really a powerful journey. We're just at the beginning.
I think as a user journey, since we've been live for a couple of years, you can send money to our bond exchange at, it's like 3 in the afternoon. You will receive it on your account in less than a minute. You can buy a bond and earn tonight's coupon, right? So that's not possible using extant technology and processes. If you sell the bond, within a minute, you get the cash proceeds. So that's the power of digital assets. The assets are in your name. It's not omnibus with, someone who is not recognizing you and your legal title.
Jacek, anything to add?
Yeah, I'd pretty much, echo the same what my colleagues, actually, said here. But, also I'm gonna make, quite, maybe strong remark here. Number one, this ops efficiency, Myles, you were pretty much, saying this is absolutely, the game changer. But pretty much all I really wanna say, liquidity, these days, is absolutely critical, and with blockchain, you can enhance, transparency, traceability, which is absolutely key. And what we've learned actually, most recently in financial markets, even, highly liquid assets can become, illiquid in times of stress. So having, blockchain layer or technology on top of it can, enhance, this liquidity or transparency, which is, for the better for the entire market.
Okay, thank you. So we've covered advantages. What are institutions looking for, and what is their motivation? I mean, obviously some of their motivation will be those advantages, but, what else? What are they looking for? Do we know?
Sure. I mean, a lot of it is actually what we talked about, but I think at the same time, for institutions actually to adapt, this space in a meaningful way, they look for regulatory clarity, right? So that's important. They look for institutional grade services as well, right? So that's really, so you can't play in the space, if you really don't have the scale, if you really don't have the resiliency. So they also look for those key enablers to be in place for them to do that. But at the end of the day, you really have to kind of just focus on what new things that you can do with this. What problems is it going to solve? So it goes back to a lot of the things that we talked about. So it's being very deliberate about actually the use cases. So for instance, in the private asset space, can benefit from putting those assets on the digital rails and being able to actually tap into market the liquidity that you couldn't do before. So those are the things. They're really looking at the bottom line impact, but at the same time, the key infrastructure that would allow them to participate in this space in a meaningful way without taking unnecessary risks.
Yeah, expanding on that. Public markets are already digital. We may or may not like the way that they're digital, but they are digital. And they're actually pretty efficient in most markets. So what we're really talking about in digitization here is private markets, in the private sphere. Private markets, if you look at the last few years, notwithstanding the recent market fear, the last few years, private markets have grown at 1.7 times the rate of public markets. So actually, private markets is experiencing tremendous growth. We're seeing all of the tools come in place that allow participants to transact in private markets in a significantly more efficient way, and therefore access liquidity more efficiently, therefore change their risk profiles, therefore be able to allocate more to private markets, therefore accelerate that growth in private markets even further. So we're really seeing a fundamental shift in the way markets are constructed right now.
I think on the negative side, if I may just add, sometimes I feel DLT, and this is half a joke post-lunch, is like truffles. You can add it on anything and magically improves it. It doesn't. If I need a 10b5 opinion on a prospectus, DLT can't speed it up. A lawyer has to give that opinion, right? If certain condition precedents have to be met, then they have to be met. So it's not that DLT can, actually speed up everything. So to me, the more conferences like this and practitioners discuss and debate what helps, what hurts, the better it is.
Stephen, did you have something to add?
Yeah, I guess just going back to maybe marrying your original question of institutions, and I interpreted that as institutional investors. Maybe that's a little too single-threaded, but I think ultimately what they're looking for is the things that they have always looked for, which is investment opportunities, maximizing, profit, reducing costs, and it's all how digital securities can help materialize those in a different way and kind of extract value for them. So if we look at the long road to all securities becoming digital, playing into the title there, I think where we're importantly at in that journey now is people starting to actually look at where they're getting benefits out. There needed to be a few vendors in the space, issuers in the space who take the leap and be the first to do it, but it allows us to focus on the conversation on, not just how do I get real-time settlement, it's how am I maximizing capital efficiency by having real-time settlement, and that metaphor applies on to, I think, all of the value statements you could align to digital securities. So I think early in that journey still, but we've certainly gotten over some humps and are starting to really see it kind of perpetuate across the market.
Thank you.
I would pretty much say, Steve, what you said, real-time settlement is absolutely key, and we had, multiple examples in the last, couple of years. Started, by mid, March with the global pandemic. Then we had, war in Ukraine. Then, we had guilt, crisis. So pretty much we see that this T+2 is not a good thing going forward. So market is crying for the solution, to settle pretty much, instantly to boost, liquidity. So that will be pretty much, the way to go. And with DLT, it is possible to achieve.
Sorry, I just want to play into one thing again on the title. Completely agree with everything that was just said there. I think it's just important for us, everybody in this room who has sort of self-selected to be at this conversation, that we agree we need real-time settlement. At the same time, across the world, we're talking about shifting from generally aligned to T+2 to T+1, and everyone's raising their hands and saying, is 2 years enough time? Do we need more time? So it's a little bit of a, mix. How do we make that happen? How do we say we need real time now when other core parts of our organization are saying we're not ready to cut 1 day off the settlement to go to T+1? So I think those are the challenges that are in front of us, and that's kind of what makes this road to all securities becoming digital a longer road. Not to keep using that metaphor, but I think it really is a good question of how do we take the innovations we can come up with right now and make sure that those stick and that we're able to get revenue on them and all the things that will continue funding those projects so that these don't just turn into science experiments. So we really reap the benefits.
If I could just add one point there. So real-time settlement is actually a bad thing. T+0, great. T+1, okay. T+0, fantastic. Real-time settlement is actually really bad because in order for a market maker to be able to accurately and efficiently perform their function as a market maker, they need end-of-day net settlement. The amount of cash that your standard market maker, pick any securities firm, would need on balance sheet to be able to do market making with real-time settlement is more than makes their business economical.
Yeah, I think we've seen some of that in some of the work that DTCC has done over the past couple of years, looking at where's the fine line between like netting efficiencies and balance sheet efficiencies. But I think the answer where we kind of realize we're heading is it's less about what is the settlement cycle. It's more about like what settlement cycle is right for me. And I think that's the way the world's moving, and flexibility will become key. That happens to be something that blockchain is very well positioned to do. Programmatic rules, it's kind of in the DNA of blockchain. So I think it's really helpful moving there. And as the world shifts from T+2 to T+1 in public markets, I think something that we're really seeing is an increased focus on, when we went from T3 to T2, it's like, how do I change the minimum amount of bits and bytes in my system to allow T+2 to work? And I think now this transition is a little bit more of how do I prepare my systems to be more flexible for whatever comes next.
Okay, I want to come back to challenges and also how long that road is. But first of all, I wanted to ask you, will all securities become digital? What do you think? Okay.
Yes, it would be, but I think it would be unrealistic to assume that's going to happen in the next, a year or two. So this is a long journey. So I think we need to be prepared for that hybrid construct, right? But at the same time, for clients actually to have not a disjointed experience, right? To have some of that actually abstracted away from them, in a way that they can tap into, in this world. We recently, collaborated to do this independent study of institutional investors. So we reached out to, 300 or so investors globally, and different mix. And one of the stats from that, for instance, was, more than 90% of them are expecting to invest in tokenized assets. So you can see there's already consensus forming into that being the future. But at the same time, nearly 3/4 of them are really seeing actually and having an integrated experience as one of the key things, for them as well. So I think it's going to be a hybrid for the near future, and we just need to help that road be easier for our clients.
And talking of that road then, you've said it's not going to happen in the next 1 or 2 years. Do we have any idea when, how long is that road?
So in my view, in order to get there successfully, it really requires central pieces of market infrastructure to take the lead on that, such as the DTCC. We've got a project which we just launched the Johannesburg Stock Exchange's private placements market earlier this year on our platform. And that is a entirely digital end-to-end placement, register management, secondary liquidity solution for private markets. We're now in the process of connecting that to their digital public markets. And so actually a public entity can actually have public-private interoperability between doing a private liquidity round off-market on their private placements platform, and that's synchronizing back to their public markets, register, and CSD in South Africa. So it's entities like that central pieces of infrastructure that's going to bring all that together, and like the DTCC in the US. And it's those entities that create that base foundation by which institutional investors can actually engage in digital world.
My view on bonds, right? So today we've had, 30 bonds that have been done on blockchain. I think by 2030, almost all bonds will be issued. So another 7 years to go. But we will have conversion, like in equities we had dematerialization. So we will have, somewhere in this journey, securities that can trade in hybrid format or dual fungible formats. But at least 7 years. So if you take this from 2018, when World Bank issued the first blockchain bond in Aussie dollars, it's a 12-year cycle. And this is about 60% faster than what we saw in, let's say, the green bond technology, where the first one got issued in 2006, and today about a third of all issuances in green format. So 12-year journey in which I think we have 4 years in.
I would pretty much, agree, but let me give you, some good, maybe picture here. So probably 3 decades ago, we've seen, electronification of markets. So we started with FX, then, we moved, to equities, then, bonds, then, even now today you can trade, electronically on electronic venues, structured products. So with regards to digital assets, it's exactly the same happening. So we started with, cryptocurrencies, then, we can also, trade, digital, equities, then, we started doing, digital, money market instruments. Very soon, bonds will be, the next one. Then we're going to move, to more sophisticated, asset classes. So I would say 12 years. This is the absolute minimum because market is not ready today, to accommodate it. It's simply we're not ready. But the light is in the tunnel, and I believe in the next, few years we're going to see some really, tangible results.
Stephen?
I've stopped putting year estimates out there because they prove to be incorrect time again. But I'll say on the one hand, we see things moving faster than ever in some pockets, but I'll counter that with every bank that's in this room still has fax machines somewhere in their office. So we got to balance those two and figure out. So I think we'll see significantly more in 2030. I like to anchor that point, but I certainly don't think all securities will be digital by then. There's just this question of these $100 trillion of outstanding securities and how do those become digital, and you could argue whether they're digital now or electronic, different definitions, but so we're certainly on the path to having significantly more, but just so hard to put a date on it.
Okay, thank you. And can I stay with you for a moment? What do you think the main challenges are?
So I'll come down to business cases. I think the large, financial institutions at the end of the day have right now teams focused on this, and those teams are growing and becoming more impactful, but they also have all the business units that contribute to their P&L. And I think to the extent that their services starting to go live and contribute to that P&L, it's helpful for the innovation to continue. And I work in an R&D lab at DTCC, and you can do a lot of things in R&D lab that aren't as simple, and they're a lot more expensive when you try to move them into a production sense. So I think it's competing resources. 2 years ago, things were going great. The economy was doing pretty well, and it made it very easy. As we head into 2023, budgets are kind of cutting back across the industry. So it's when will we start materializing those benefits from a profit loss perspective. I think most financial institutions view this as strategic investment right now, and that's great. But at a certain point, it will need to turn into true realization.
Okay.
I would say blockchain is all about networks, and it is about ecosystem. It's really hard to build this network when you have so many competing initiatives. So in the end, sooner or later, we'll need to really stick to the very few competing initiatives and really make the most of it. It's all about network, I'm afraid.
Okay, thank you. Rahul?
I think I basically agree with them.
Okay, fantastic. Anything to add on the challenges we see ahead?
Look, I think we shouldn't underestimate the learning curve, right? The learning curve, building the talent base. We're seeing, the underlying technology and how it can be applied to really solve these problems. The convergence of, the digitally native companies and the new innovation that they're bringing in with the traditional finance and the lessons that we've learned through the decades and decades of that, right? Like, so really just combining all that stuff is going to help us now to navigate the space. The infrastructure is really key. Some of the, I speak for BNY, for instance, I mean, the digital custody infrastructure, for instance, I mean, that we just launched, even though the initial beneficiary would be, crypto assets, it is designed in a way, actually looking at that future where all these assets are going to be in that infrastructure. So some of these things are going to have really accelerate it's going to enable others actually to come into the space as well. And of course, we can't underestimate the regulatory framework and that, to really just look through the technology, have a technology neutral approach that actually allows us to have responsible innovation while managing the risk. So all those things need to happen for us to get to that vision.
I'll just add very quickly, you mentioned a couple of points, learning curve, regulatory aspects, and digitally native companies. So there's a very interesting clashing of heads, so to speak, from technologists who have approached this market, who have created bearer securities, where the institutional capital markets world doesn't actually function on bearer securities. They all have registered instruments, and that's why you have the DTCC. Makes a lot of sense. Actually, over the last several hundred years, capital markets have moved away from bearer instruments and to registered securities. So, putting that in context, actually, we really need the audience in this room as the leaders of moving to a digitized framework rather than a digitally native audience set. And so the really important point here is that definitional problem of saying exactly what are we trying to solve. Like, digitization means a lot of different things. Tokenization is one element, but it's really just one small part that allows for less friction in the transferability process. But to have the legal settlement finality, there's a whole lot of underlying processes there that have to go into that, such as stamp duty in the UK, and other parts of friction. So, we've digitized a lot of that, and actually that's all possible to be digitized. A really hard one is some of the transfer agents, some of the registrars in certain countries, like in Germany, for example, actually quite antiquated with private markets, but we digitize all of them. We digitize all those processes, then we add tokenization over the top, and hey, guess what? You can now transfer a token, which then triggers all of these processes, which result in legal settlement finality. And it's really that learning curve, for me, is the most important one.
Brilliant, thank you. We have 1.5 minutes left. I don't know if we want to get a quick question, if anybody has a question for any of the panelists. No? Okay, well, that's fine. As I'm chairing this afternoon, I'm committed to keeping it running on time. So thank you so much to my excellent panelists for a brilliant conversation, and thank you to the audience.
Thank you.